Well, hello, everyone. My name is Steve Raye, and I'm president of a company called Bevology Inc. in New York. We are a marketing consulting company that specializes in helping export wine and spirit brands grow in the United States market. My contact information is on the screen, and it'll also be on the last slide. Since this is being recorded, we won't have any options, obviously, to ask questions. But if you do have questions at the end, you can, at the end of when you're listening to this, you can email me directly at steve@bevologyinc.com, or also, if you'd rather, direct questions to the folks at Beverage Trade Network, and they will make sure that it gets forwarded to me. So the subject of today's presentation is understanding American price structures. And the one I'm going to show you an example of is a wine price structure, although the principles apply just as well to spirits. And I'll use one factor on spirits taxes to help you understand that. And I think there's a couple of basic things that I want you to understand about how price structures are calculated in the United States. And I think the most important thing is that everything is negotiable. What I'm going to show you is a basic outline or framework for doing a price structure, identify all the different pieces of it, where they come in and when they come in, and what is markup-able, to give you a sense of the structure. But at the end of the day, it's something that's going to be negotiable between you and your importer, or you and the distributor if you're importing yourself, and something that you really need to understand all the ins and outs of, so that you can make sure you don't leave any money on the table. So let's just jump right into it. And we're not going to get to the price structure itself yet. We'll get you to a solution that may be something that will save you a lot of mathematical errors. A very simple rule of thumb that you can use is your retail price is going to be roughly 3.5 or 4x your ex-seller price. Convert it into dollars, and there you go, multiply it by 3.5 or 4, and that gives you a good kind of rule of thumb. Another way of looking at it, and also putting maybe a comparison to, is 2 times the distributor laid-in cost. And we're going to define the laid-in cost as we go through the price structure itself. But if you don't want to listen to any more of the presentation, you can leave right now, and you have enough of what you need to know. But I think you'll find the rest very useful. The key point I want to make here is this is a model, and it's really a point of reference only. As I said, everything in this whole process is negotiable. It's very definitive, each of the words, the terms, and the money, but not all of them are fixed, and we're going to show you which ones are. So make sure you really understand that you can play a significant role in negotiations in maximizing the potential profitability for yourself, and also understanding what the benefits are to the individual importer or distributor that you're working with. So recognize that there are factors that are not included in this model, and they include a bunch of things, including marketing support, which often can be as a direct contribution in terms of cash. It could be as a % of sales for tasting. It could be an allocation of free goods. It would also be used to support programs such as wine dinners, in-store tasting events, public relations programs, depending on what structure of PR support your importer has. Also not included are samples. We generally figure that you're going to be using 2% samples from the winery that's going to get matched from either the importer or distributor, that there will be discounts applied, and that's part of the negotiation process. And we'll give you some definitions of terms. A few that I've put out here are DA, which is a depletion allowance, and that's a way of discounting a product after it's sold to a distributor. SPA, which is a special purchase allowance, which is a way of discounting a product prior to the purchase. FSA, floor stock adjustment, which is a price adjustment, as the word implies, that can apply to both the distributor and the retailer. And then what you'll find in many states, and I use New Jersey as an example here, they all have their own terminology and structures. In the case of New Jersey, they're RIPs, SIPs, and MIPs. RIPs is a retailer incentive program, MIPs is a management incentive program, SIPs is a salesman incentive program, and they will be individual line items in the price structure that you work out with your wholesaler in New Jersey. And just in case you're thinking this might be simpler than it seems, there is many complications in many other states, and I'll use one as an example. And that is, in Texas, there is a fourth tier. In Texas, they have a law that's called Class B license. And what that means is an on-premise retailer, bar or restaurant, cafe, so forth, can only buy from a retail store that is licensed to sell to on-premise accounts. So the on-premise account cannot buy directly from the wholesaler himself. The on-premise reseller can only buy from a licensed retail online sales entity. And so that basically adds in another layer of margin and gets factored into the pricing. But what you'll find is Texas pricing actually is pretty comparable to other states. As to how that happens, frankly, I can't give you the answer, but if you have a salesman in Texas, I'm sure he can explain it to you. Okay, and then lastly, the point here is that everything I'm saying applies in specifically only to open states, although structurally to control states as well. And for those of you who don't know the difference, an open state functions as an open market, that there will be a distributor would sell to a wholesaler to a retailer, and so on. In a control state, it's much like Sweden or Norway or Canada, where the state is in some cases the buying entity, and in some cases also the selling entity, meaning they'll be functioning as the wholesaler and also potentially as a retailer. Pennsylvania is an example. So today we're only talking about open states, but in some of the details I'm going to give you later and on the spreadsheet, we do have individual state tax rates for all 52 taxing entities. And I'll explain the 52 in a moment. We'll get to that. Okay, so terms and terminology. It's very important that you understand, not only that you understand, but that you and the person you're negotiating with are using the same definition for each of these terms. And I'm going to talk about a few here and then one more slide. But I would urge you at this point in time, there's a book out there called How to Import Wine, written by a woman by the name of Deborah Gray. I'll repeat the title, How to Import Wine. She has a glossary in there. She explains the whole process in greater detail than I'm doing here, and she has a lot of formulas that you can see in there as well. Everything that she says agrees with what I'm saying and vice versa, but it's maybe an easier way for you to refer to it. So let's get down to the terms and terminology. In the United States, a distributor is synonymous with a wholesaler. They mean the same thing. I know in Europe and some other countries, sometimes a distributor can play the role of an importer. That's not the case here, although some wholesalers do import. But when we talk about them, the distributor wholesaler, we're talking about that price or that tier in the pricing system that is very discrete and different from the importer and from the retailer. FOB is a term that gets used and misused a lot. And in fact, doing some research on it, I found it's got two different definitions. One is called free on board, and the other one is called freight on board. And in practice, basically what it means is it's the price being charged from the supplier to the importer. And then another use of that term is from the importer to the distributor. And you'll see in the price structure that I'm going to show you in a moment where those come in. But since it means free on board, the definition is really pretty simple. It is what is the value of that product to the purchaser when it has been loaded on a ship in a certain place. So if it's coming ex-seller, then it's your ex-seller price. If it is on a boat in Hamburg or in Ica, Peru, then that's what it means. But it's after all your inland costs for transportation would then be captured in that as well. We talk about the laid-in cost, and by that we mean the fully loaded cost to the distributor before markup and before sales taxes. And you'll see that very clearly on the spreadsheet. And then lastly, the wholesale price is what we call the front line, or an undiscounted price that is charged to the retailer. And then on that, a distributor may use depletion allowances or other ways, floor stock adjustments, to adjust the price, and help the retailer adjust the price. At the end of the day, the retailer makes a decision on what the retail price is. Manufacturers, suppliers, importers, wholesalers can make recommendations, but they cannot. Indeed, it is illegal to dictate retail price. Two others that you need to know are three actually here. One is the federal excise tax, also called FET. And this is the tax based on the alcohol content that the federal government charges. It's a fixed rate. I believe it's $2.55. We'll see it in a second. But even within that, there's always room for managing costs, because you only have to pay the federal excise tax. Well, you have an option of paying the federal excise tax when it comes into the country, clears customs, and goes into a warehouse. You can, if you want, put it in a bonded warehouse, meaning you don't pay federal taxes on it until you withdraw those goods and put them in commercial sales. Now, there are pluses and minuses of that. For example, there's in and out charges for on the part of the warehouse, storage costs, and so on and so forth. But as a way, if you need to conserve cash or manage cash flow, that you can do things. Again, it becomes a strategic tool. And in pretty much every line of this thing, there are examples of that. I would also highly recommend that if you are not very familiar with the US market, that when you come here, when you talk to people, that you have someone working with you behind the scenes or as a consultant to help guide you through this process, so that you're making sure you're asking and getting the right questions answered and interpreting the answers the right way. Sometimes it seems like price structures in the US is like buying a used car, but it's not. There's very definitive terms, and it's incumbent on you to make sure that you understand them and are conversant with them. Having an advisor helps, whether it's somebody like me or a salesperson that you engage, whoever it happens to be. The last two are duty, which is separate from the federal excise tax, which is the duty on the value of the product as opposed to the alcohol content. And then lastly, the state excise tax, which is the tax on the alcohol component of the product. Definitions may vary per state, but in the chart that I'm going to give you, there's a separate worksheet that lists out specifically what those state excise taxes, and they've been converted to cost per 9-liter case. So I'll show you that in a moment. So let's start with the basic document here. And what I've done here, you'll get a copy of the Excel spreadsheet as part of this webinar. I'm not quite sure how, but if you have any questions, you can email BTN and they'll send it to you. But what I've done here is highlighted in green those numbers that you can adjust or confirm or change yourself. So here, if it's 55, I've got it as a 55 euro FOB price at the port of debarkation. Yours could be 30, could be 80, could be anything. And then also you can change the conversion ratio. I'm using $1.09 because that's just what it happens to be today, the day that I'm recording this. And then as you look at this chart, basically we're going to have two different versions of it. One version is for a full case, and we in America talk about 9-liter cases, which is calculated as a 12 by 750 ml, or it could be a 6 by 175 ml. Those we call magnums. They still total 9-liter cases. And then I've corrected that or broken that out for a individual bottle cost. We don't usually talk in these terms. We talk in these terms, but this will help you understand. I hope it's. So here we have the FOB, 55 euros, 59.95 based on the $1.09 exchange rate. And then you have added costs for things like ocean freight, insurance, duty, inland freight, warehouse charges, and so on and so forth. And the so on and so forth are detailed on the Excel spreadsheet I'm going to give you, but also here, where I've broken them out individually. Ocean freight, marine insurance, ad valorem and harbor tax, duty, I talked about that earlier, and then an estimated inland freight from port of arrival to the warehouse of the distributor who is going to be selling it, and then warehouse charges. And these, for example, could be the receiving charges from Western carriers or one of the other storage warehouses that you use. Not all of these are fixed. And some are things that you're going to buy on your own and then have to allocate out. For example, ocean freight, depending on what country you're coming from, Australia is going to be a lot higher than it would be coming from Portugal, for example. In addition, there are some other things that could be added here that sometimes you see, I don't often see. One example is peer pickup. Frankly, I'm not quite sure what that actually is, but it's an added charge that goes here. So if we go back to this, you can see I put the 595, which was this 595. So you've got to do your calculation here. You'll come up with a number. And in reality, that 595 ought to be in green. We know that the federal excise tax is going to be $2.55 per 9-liter case, which works out to 21 cents a bottle. So that becomes, these costs get added. That's what this column is. So 59 plus 595 plus 255 gives you 68.45. And that is what we call your landed cost, which means what the value of the goods are sitting in a warehouse from which a distributor can order the product. And it assumes that federal duty has been paid and the product is now out of, been withdrawn from the bond. Then the importer is going to put a markup on that. And I'm using 40% markup, which is a 28% margin, just as a point of reference. Could be higher, probably not. Definitely could be lower. It all depends on what you negotiate with your importer as to who's going to be providing what services. If a given importer has a public relations department, or does not, or they sub it out to somebody else, what their sample policy is, and so on and so forth. But we use 40% just as a point of reference. Again, this whole thing is a point of reference, and it's kind of like a most expensive case scenario. Usually you can negotiate down from, again, depending on what you're going to contribute. In any case, a 40% markup on that equals 27.38 cents. Then you have the inland freight. Again, that's going to vary. If it's just going from inland, from Western Carrier's warehouse in New Jersey to Winebow's warehouse in New Jersey, it's not going to be $1.50. If it's going to California, it may be a little more expensive. So we use the $1.50. So there's, it adds $1.50, which equals 13 cents per bottle. And that gives you your FOB to distributor, or what we would call the laid-in cost. And this is the price that distributor pays before state taxes or markup are added. So laid-in cost, $97.33. We had said that earlier that the estimated price of the product is going to be either 3.5 this, your FOB price in US dollars, or it's going to be double the laid-in cost. So in this case, it would be 1622, and I can't do 3.5 times 59.95, but if you would do that, that's the number that will be a point of reference. Then you add state excise tax, and that's going to vary a lot too. And as an example, and I'm giving you on this chart, excise tax rates for individual states for wine. Now, these may vary a little depending if it's over 14% alcohol, and as you know or may not know, the federal tax on wine changes when it gets above 14%, or if it's sparkling wine. So again, I'm only using these standards here are for still wine under 14% alcohol. But it matters because look at the difference. Here's Alaska at $5.94 a case compared with Louisiana at 26 cents a case. It's important that you do that because when you do a price structure, we highly recommend that you do an individual price structure for every state separately with the group that you're working with in that state to make sure that nobody leaves any money on the table. And what do I mean by that? Well, say you've gone through your whole price structure and here's what your retail price per bottle comes out at. Well, no one's going to sell a product on the shelf for $18.34. That might be a $17.99 product. It could be an $18.99 product. It could be a $19.99 product. It's something that is set by the retailer, but the retailer knowing and being conversant in the way pricing is structured and deals offered in their particular state. So let's go back to where we were. We had the FOB at 97.33. We added state excise tax, distributor markup. That now equals, we have this to that, gives us $146.71. Now we go down to the third tier, which is the retailer. The retailer is going to put a 50% markup on it, which is equivalent to a 33% margin. And that adds another $73 to the total to give you a $220 retail price per case, which converts to $18.34 retail price per bottle. So this becomes a point of reference. You have other factors that you need to calculate in when you're thinking this. Our objective here is to give you a sense of the structure and how all of these numbers get factored into the price structure. And from there on in, you'd be on your own. Again, as I mentioned, we highly recommend that you have a competent person who understands all this in that state working with you when you're negotiating, or your export manager becomes very familiar with it. As I mentioned earlier, we don't have the opportunity to ask questions, but I had given this presentation in Italy a month or so ago. We did get a couple of questions, and I'll share those with you because I think they're relevant and maybe the kind that are in your mind. One of the questions is, how do we, first question was, what do you do if you want to change distributors in a franchise state? Let me explain franchise states. Franchise state, we have about 14 of them, means a state like Massachusetts, Connecticut, New Jersey, and Georgia are four that come to mind. That means that if you assign your product to a wholesaler in those states, you can never fire them. So what do you do if you're unhappy with the job that they're doing down the road? Well, one of the options you have is called go dual, meaning you can hire another one to also be having your product. Just because you give it to someone doesn't mean they have it exclusively. So that's one solution. So oftentimes you can think of things like franchise states as a market launch or rollout strategy in your planning for market launch and rollout to figure out what are the best solutions for you. Because fundamentally in a franchise state, you're going to have a different set of distributors than you would in a non-franchise state. New York, for example, has 2 major wholesalers. Georgia has 6. Next question we got was, they were asking a bunch of questions in terms of exclusivity, terms, payment, all that kind of stuff. And my recommendation there is there's another webinar in this series about contracts, and I highly recommend that you listen to it. Interestingly, we're going to have a presentation on that at the USA Trade Tasting on March 23rd, 2016 in New York by Donna Hartman. But essentially, it's very important that when you negotiate with anyone, whether it's an importer or wholesaler, you won't have a contract with the retailer. So those two, that you really understand the terms and terminology, how the price structures are structured, and talk through and resolve in advance any issues that might come up so that you don't have any problems down the road. And one example of a good idea that we heard that we recommend to everybody is, what about currency conversion rates? You know, currency is changing all the time. The euro may go from $1.10, it's been up as high as almost $1.40. The Aussie dollar was above $1, now it's down at 78 cents. What we recommend is that in your contract with the importer, you agree to say, okay, we're going to establish the price of the product, or the conversion factor for the product based on whatever the Financial Times in London quotes it at on a given day. You guys pick it during the year, and that becomes fixed for the year. Anytime there's a change between 0 and 15%, either way, the person who gets hurt absorbs it. Once it goes over 15%, then you're going to sit down and talk about it and see how you can ameliorate that situation. But what this does is it takes out the makes everybody know that, okay, here's the deal. If it moves 12%, we've already said either I'm going to get the benefit of it or I'm going to absorb the cost. And it may not be 15%. You might want to do it on 10% or even 5% for that matter. The point is everything is negotiable, but it's very important that you negotiate everything. I think that's a great takeaway from this. Everything is negotiable, but please make sure that you negotiate everything. That way you'll make sure that you fully understand what you're dealing with. Don't get sideswiped and don't leave any money on the table. So that's the presentation for today. I have my contact information here. And if you have any questions, feel free to email me at steve@bevologyinc.com. If you're listening to this presentation, that means you're somebody I'd like to connect to. So reach out to me on LinkedIn and connect. I publish a lot of information like this on my LinkedIn site. And also you can reach me through your account at Beverage Trade Network. And if you're not a member, I highly recommend that you become one, because I think you'll find the wealth of information in terms of articles and webinars that they have there, exactly that, a wealth. It's incredibly valuable. And the more you know, the more unlikely it is that you're going to have someone take advantage of you. Our whole goal in this process for this particular webinar, as well as all the ones that we do, is to minimize the chances of you being taken advantage of so that you can maximize your chance of success in coming to the US market. So thank you very much for your time. I appreciate it. My name is Steve Raye, Bevology Inc., and I hope to see you soon around the world.